So let's talk about the circular flow of the economy. The circular flow of the economy is a way of describing the interconnectedness of different parts of the GDP. In GDP, we have consumption or consumer spending, we have business investment or business spending, we have government spending, and we have net exports, which is the net difference between what is exported from a country from what is imported into the country. So, this is our circular flow. I know it doesn't look like a circle, it looks like a rhombus, but it's describing the same thing we're going to talk about. So, over here, we have households like you and me. This is us doing this our part. This is the consumer spending part of it. Over here, we have business spending or firms, and these are the firms. And down here, right here, is the products market. Well, I want to say that economists, one of their buzzwords, their favorite word is to say market, 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 market. Everything's a market. They talk about stock market, they talk about products market, they talk about factors market. And in this case, we're talking about right here, down here is the factors market. The factors market is where the factors of production are bought by firms to use in producing final goods and services. Those are natural resources like land and water, um, labor like you and me, physical capital like plants and equipment and machinery. There's human capital, which is the knowledge and skills of labor that is not just turn a screw, it's the knowledge that you're learning here right now in your classes. And that gives you that edge among other pieces of labor. It's called human capital. Why would you hire a laborer, a landscaper, to do your accounting? You won't, because you want someone who has that skill at being an accountant. That's that human capital. And the fifth piece is entrepreneurship. And entrepreneurship is the knowledge and skills and experience in running a company and knowing how to allocate scarce resources to get the products to the consumers. Why is Mary Barra head of GM? Because of her skills and experience and knowledge in running GM, for instance. So, back to our circular flow. So, our circular flow starts over here where we have our households. Now, households, and we have here the products market. Yes, the products market, right over here. So the products market is where we buy and sell, where firms buy and sell products and we buy it. So if you follow the green arrows, and the green arrows, because we're in the United States, green equals money. So we're talking about the flow of money and the flow of products and services around in a closed economy if we look at just from this point down. So just this rhombus in the center here is what we're looking at right now. So we go to the products market, and in the products market, we buy cars, we buy milk, anything we buy, we go into the products market. And in the products market, the firms supply, that's the red line, so they supply products to the products market, we buy the products, and we pay money for it. And that's the green arrow that comes over here and then goes down here to the firms. So the firms get paid. Now, in the labor or the factors market, we follow the red, supply the labor, for instance. So households supply labor to the factors market. That's the red coming down here, and we get paid for it. So we get money for being part of that market. Here on this side, we have firms that get the labor, that's the red arrow, and pay money for it. And that's how the closed economy will work. We supply Factors are used in production, producing goods and services that are in the products market that are bought by households. That whole cycle works around and around. In a closed economy, that's how it works. Now, there's a third part to the closed economy, and that's the government, right here in the center. And the government buys stuff from the products market. We buy coffee, firms buy coffee, and the government buys coffee. Everybody likes coffee. Well, maybe not everyone. You guys may not all like coffee, but I love coffee. And that's one thing I would be buying in the products market is coffee for my household. In fact, all of us like coffee in my household. So the government will buy coffee for the employees. Well, I just said it. Who's drinking the coffee? Well, employees do. So the government actually does go into the factors market to hire employees. People who work for the government. And the government employees want coffee, so the government goes and buys coffee for the employees, for its use, for the government's use. Now, where does the government get its money? We just said here that households get money through the factors market from firms, and firms get money from households. So that's where they're getting the money. Where does the government get it? Gets it from taxes. That's these blue lines that are here. The blue lines here going into the government, right here. So that is a closed economy. The government spending money to buy products and services, households spending money to buy stuff, and firms investing money in machines, in factories, in plants, in vehicles. Those are assets that the company will use to grow its business, and that's the business investment. So already we've talked about two markets. There's a third one right over here. The world. Now, in an open economy versus a closed economy describes only an economy where the products and services are bought and sold within that economy. There's no outside influence, there's no importing or exporting. Now let's add that another piece to it, and that is the rest of the world. So in this closed economy, now it's opening its borders up to ship finished goods from the products market outside to the rest of the world. So it goes from the products market to the rest of the world. And we also import into this economy from the rest of the world into this economy. And that's exports going out and imports getting in. So remember that when an export is shipped to another country, the people that buy it in the other country, that money comes back to our economy. But when we buy a foreign good here, that money goes back to the other country. Give you an example. Ford sells a car in Bavaria. Bavaria is a part of Germany. So when a German Bavarian buys the Ford Focus in Germany, that money comes back to Ford, which comes back to the U.S. In fact, it comes back to Southfield, Dearborn area, because that's where Ford's headquarters is. So it comes back to Dearborn, and that's where we get the money in Michigan and in the United States. Now, instead of buying that Ford, you go down the street and go to the BMW dealership, and you buy a BMW. Where does that money go? It goes to the BMW dealership, yes, but eventually it goes back to Germany. Actually, BMW stands for Bavarian Motorwerks. And Bavarian Motorwerks is in Bavaria, which is part of Germany. So that's an import. We know that the BMW is imported to the United States, and that money's going out. So it's described right here as we're going from the products market out. That's the Ford Focus. And in, that's the BMW coming into the economy. The market is not just the foreign versus domestic market. We talk about what's called a foreign exchange market. The reason why we talk about foreign exchange at that point is because the amount of goods that a foreign country is going to buy from our economy is dependent on the relationship between our currency and that country's currency. If the price to them is higher for our imported goods, which is our export, then they're not going to buy as much because it's cheaper to buy domestic. Conversely, if the exchange is such that the price that they see for our foreign imported goods is cheaper than the domestic, then we will be shipping more. So the foreign exchange market is very important in managing this international, and we'll talk more about that later. Now, there is one market that is overarching all of this. It's overarching this whole thing as a yet another dimension, and it's the loanable funds market, or another way of saying it is the money market. The loanable funds or money market, I'll be using those interchangeably at this point. Later, I will make it more of a distinction. For us to buy stuff, sometimes we use cash, and sometimes we use another form of payment. What is that other form of payment? Credit cards. Yes, credit cards are not cash, even though a vendor or retailer will handle it much like cash from your perspective. You either give them your debit card, you give them a credit card, or you open your wallet and give them cash. All three, or you write a check. All those are forms of payment. But from the retailer and from the bank's point of view, cash is cash, checks are a part of cash, but credit cards is a debt. That means you owe that money. So that is a liability from your perspective, from you to the bank. That's borrowed money, and you have to pay interest on it sometimes. So that borrowed money is part of this loanable funds market that I'm talking about that's overarching. And we will borrow money. Sometimes we borrow money to buy a house. Sometimes we borrow money to buy a car. Sometimes we use a credit card to buy groceries. Those are all forms of borrowed money or loanable funds. And sometimes we have to do that. Now, businesses also will borrow money. They have to borrow money for these capital expenses, capital expenditures, like buying a factory or buying machinery. Sometimes they don't have cash for it. They'll have to borrow the money for it. And in that borrowing, then they also have to go to that loanable funds market, the bank, to get that money. The government also will have to do some borrowing too. In fact, currently, if you're watching this right now, the government has borrowed a lot of money and has been borrowing a lot of money lately to spend on these economic programs that are helping the economy come out of the COVID-19 pandemic. The increased government spending is more than its tax revenue, and that is because people are not working. A lot of people are still not working. There are a lot of businesses that are still shut down, not just here in Michigan, but all over the country. And those businesses that are shut down need some assistance, and that's coming from the government. And that government spending has to come from that money that the government spending has to come from somewhere, and it's coming from borrowing. So it's borrowing from the bank. So the bank is part of this overarching dimension to the circular flow, and yet a different market called the loanable funds market or money market. And we'll get more involved in each of these markets in a little bit. So just so you know and understand the circular flow and how the circular flow flows, and it knows it flows, and you need to know it flows from households to firms to the government to the rest of the world. Oh, I didn't realize that you were there. I was just enjoying our little mini video on the circular flow of the economy. I thought it was interesting, quite fun, quite interesting because the circular flow of the economy actually, that one picture is not merely 1,000 words, it's 1,000,000 words. It talks about the different parts of GDP, which we talked about in Chapter 7. It talks about the different markets that are also discussed in Chapter 9. I talked about it in the video, but it also talks about the loanable funds and the money market, which I tend to combine. But the money market and the loanable funds market are kind of the two
aspects of the same thing. We're talking about money and interest rate. The money market is one of the really it's one of the overarching markets with the loanable funds market. Loanable funds market is the market where we borrow money like through credit cards or bank car notes and mortgages, and businesses borrow on commercial loans, and the federal government, which we'll be discussing more in chapter 15, but in chapter 15 we talk about national debt. And national debt, the federal government actually borrows money from the loanable funds market. The loanable funds market, as I mentioned, is, and I will talk about in chapter 14 and 13 and 14, the money market and the loanable funds market is about not just money, not just a bank, but it's also stock market and the bond market. So there's really three, when we talk about loanable funds and the money market, there are three parts or three different markets that are discussed at the same time. There is the banking or money market where we save money, and money that we save is invested into the money market, and demanders of money, or demand of money is those who need money for transaction level. That transaction money is borrowed at the prevailing interest rate. If interest rates are high, there'll be more savings, but there'll be less demand because the amount is too high. And if the interest rate is too low, there'll be less savings, but there'll be more demand for money. So the money market will flow back and forth. Now, the loanable funds market is another aspect of it, but in the loanable funds market, that would be not only loans and demand for cash, but in the borrowed sense, but also in the bond market. The bond market is part of loanable funds, and the federal government issues bonds to borrow money from the public, whether it's public debt or private investment, whether it's households or foreign investment in the United States, and uses that money for its shortfalls in spending, where the tax revenue is eclipsed by the amount of budgeted spending that the federal government does. That's called a budget shortfall or deficit. And that's more discussed in chapter 15. One I want to point out in this point here is a factor, and I'll mention it in more detail, called crowding out, where the federal government goes into the loanable funds market and takes money out of the supply, which reduces the amount available for consumers, and most importantly, the other side, the other major side of that market, which is business investment. So businesses aren't able to borrow, and it causes the interest rates to exceed or go up, which pushes more investment out. Now, so the factors market is like the labor market. That's an example. The products market, which is the buying and selling of products. The international or exchange rate, which we'll discuss more in depth in chapters 18 and 19 in that video. And the loanable funds market, which is the overarching loanable funds and money market, which is overarching, discussed more in 13 and 14, and a little bit in chapter 15. So 13, 14, 15, and 13, 14, 15, 18, 19 will be discussed those markets, and chapter 9 alludes to those markets when we talk about this next concept, ADAS. ADAS, what I call ADAS, is aggregate demand and aggregate supply. The ADAS model actually was first really conceived, codified, and written down by John Maynard Keynes, an English economist who actually was writing during the Great Depression, published in 1935. Around 1935 was when he published his textbook, or his book on the economy. And part of what he discussed was GDP, which the components of GDP, which was we discussed in chapter 7, the C plus I plus G plus NX. Those components actually came from John Maynard Keynes. That's an overview. There's more detail to that. And discussing the changes or modifications of the ADAS model, aggregate demand, aggregate supply model, from what the classicists or the classical economics thought of it. Classical economics really dealt with the long run. And John Maynard Keynes said, don't look at the long run because the long run will react to decisions we make today. So we need to make decisions today in the short run to determine how the long run will eventually be. So if we make short steps or smaller steps, the longer steps will be there. So the first thing we need to talk about and understand is aggregate demand. And this is an aggregate demand curve right here. You see, it's very similar. It looks very similar to what we talked about in chapter 3 and 4, where we had price on the vertical axis and quantity demanded on the horizontal or x-axis. That's fine if we're talking about a particular market. We're talking about cars or apples and oranges. Oh, and again. Oh. Ooh, that got me a little psychedelic there and I got a little crazy. I'm sorry about that. Apples and oranges market. Or the market for tax preparation, the market for loans. All those markets are markets, and the supply and demand curve we talked about in chapter 3 and 4 deal directly with that. That's on the individual microeconomic level. Now we're going to go into the macro. And on the macro, we look at the economy as a whole. So we look at not just merely the demand for houses, not merely demand for cars, not the merely demand for apples and oranges, but all the demand combined in an aggregate. The word aggregate means combined or added to. So we're looking at the markets for all those all squished into one big chart. This is what we have here, this big chart here, aggregate demand. Notice also that we have some differences, although it looks the same, we have some differences from what we saw in chapter 3 and 4. The vertical is not price because there's no one price or one market price for all products in the marketplace and in the economy. It is a price level. So is the price level going up or is it going down or is it staying flat? That would be what we're measuring here as a price level, a relative price of products from period to period. Is it going up or down? And the x-axis, remember that we are looking at all finished goods and services in the economy, not just any one particular product, not any one particular market. We're looking at all the markets as an aggregate, all combined into one. Well, what is all the products that we produce? If you recall from chapter 7, I said that we talked about the expenditure model of GDP, which was C plus I plus G plus NX. But I also mentioned the production function, which boiled down to is a function of the use of available capital in an economy and available labor. But I also added in not just labor and capital. I broke down capital to natural resources, physical capital, human capital, and labor, all four parts, and it's modified by technology, which is that big giant A in front of the function. That the increase or changes in technology improves the entire production and improves the entire level of GDP. So you notice that in the production function, that the technology aspect is a multiplier of all the other factors of production, the four factors. The entrepreneurship, which is number 5 in my list, is kind of an overarching how to balance all that out, how to measure, how to allocate or reallocate these other factors to maximize production. The technology aspect kicks it up another notch. And so that's how GDP will move. But the function is that all products and services produced in an economy is consumed in that economy, whether it's consumed domestically or it's exported. And the GDP, it looks at the net exports of net domestic production, the net consumption of that by all the four major groups, and the production by domestic producers, which is the function. So they equal each other out. So this y-axis is that list of finished products and services available in the market. If it's available, it is consumed. The assumption is that everything available is ultimately consumed. There's no absolute waste. You can't measure waste. You can measure what we use. We go out, buy an apple. We know that's consumed because I bought the apple. If I don't eat the apple and it spoils, well, I still bought it. It was available to me as a consumer at the consumer level. So the y-axis here is measuring that GDP. And so the aggregate demand is high on the left and low on the right. Very similar. Don't be confused, but it's similar to the market specific demand curve. This is more of a curvy curve than a straight line curve or a linear curve because we're incorporating all the different price levels and the different quantity demanded for the different products. And so it makes it a little bit curvy. Why, though, is it high on the left and low on the right? Why is it negatively sloped? Why is it going from the top, high on the top, low on the bottom? Why is it diagonal like this or approaching that? With the market demand, it's a function of price and quantity demanded. That as prices go up, quantity demanded goes down. So when the prices are higher, then we have a lower quantity demanded. But when it comes to the aggregate demand, it doesn't work the same way because we're taking in consideration all the products. So there's no, not necessarily that. It is, there are actually three functions or three aspects of why this works. There are three effects. One is called the wealth effect. The wealth effect states that as prices are increasing, the value or the purchasing power of our dollar, of our currency, is reduced. As I said in inflation is the erosion of the purchasing power of money. So inflation is the changes of price levels, the increase, positive changes of price levels, which is not necessarily bad, not necessarily good, but it's a positive change. And it's a positive change. If the prices are going up, our dollar is not worth as much anymore. So it's measuring that as price levels are going up, then the value of our dollar goes down, and so our purchasing power goes down. We buy less. So because we're consuming less, then because GDP is when it's available to the consumer, if the consumer can't consume it, it is no longer considered available. So if in that case, then that's because, so our wealth effect is that if price levels go up, our purchasing power is eroded or going down. The second one is interest rate. The interest rate, if the interest rate goes up, then our demand for money goes down. Supply of money goes up because we're willing to save more, but we don't save more, so we won't spend as much. So two things are happening here when it comes to interest rates. If interest rates are going up, we spend less and save more. So we shift our dollar, and a portion of that dollar, our marginal propensity to consume, goes down, and our marginal propensity to save goes up if the cost-benefit analysis shows that we get a higher benefit of sticking it in a savings account than actually keeping it in our pocket, burning a hole in that pocket, and wanting to spend it. So we spend less because we are keeping less money in our pockets, and at the same time, we're putting it into the bank, and so we're getting interest there. So if interest rates are going up, just like the price levels are increasing, then our demand for products or our demand for money goes down. We are not going to use it because we're not going to do that many transactions. We're willing to stake that money and invest it. The economic definition of investment is saving. What we commonly call saving is what's investment. So by buying, putting money into a bank, we're saving money. That's an investment. That's an investment in the economy, in the money market. If we buy a stock, we're investing in the stock market. If we buy a bond, we're investing in the bond market. That's a form of savings because all that will appreciate, and there's different dynamics that we're not going to get into so much in this class, but we can have a discussion if you wish about it if you wish. I'd love to have a discussion about it offline. There's a lot of dynamics that we could talk about with each of these different markets, but as a whole, interest rates go up, there'll be more investment, but there'll be less demand. So the interest rate does affect aggregate demand. Now the third effect that we have here is exchange rate. Exchange rate is that part of international market, the net exports that we kind of hid away because it's not part of domestic GDP, but it is part of it is an aspect of the finished goods and services that we have. We are exporting it. But if the exchange rate is higher, then our products are actually cost more. So price levels in other countries for our products will seem to be larger. And so the exchange rate has an impact on the inflation rate as well here if our products are not selling. So if inflation goes up, our value of the dollar is going down here domestically, but we're going to ask for more outside, so that's going to increase our prices outside. So that reduces even further our exports. And so our demand, as price levels go up, as exchange rate goes up, then the demand for our products internationally go down. So that's the concept of aggregate demand. And the y-axis, the x-axis, as I said, is, and it's denoted by the letter y, because we tend to use y as the variable of GDP. As I said in chapter 7, I used y. And so that's a commonly used variable. We use y. So y is down here, but the y, the GDP we're talking about here is not nominal. It's real GDP. We're looking at the number of products, not the price. As I said earlier, we're not talking about the price. It's not an average price. It is the movement of the price levels. So if it's not moving, it's zero. If it increases by 1%, that's an increase. So it's going up to the 1% level. And you see if we go across to the aggregate demand, we see what is the level of products that are being purchased at that price level. So it's a general sense of price levels. And the x-axis is real GDP based on product. Now the next function we want to talk about is aggregate supply. Now the thing about aggregate supply is that there in effect is 3 separate aggregate supply curves. I'm going to, in the textbook talks about 2, but if you want to be really, really technical about it, in the model, the ADAS model, we have 3. We have the immediate aggregate supply, which is a horizontal line. Immediately, if prices are at a certain level, there is no limit to how much production can be done at that. It's limited to the price level, but if you are able to, as a producer, any individual producer can afford to, they will produce only at the level that is at that price. So what price meaning, not price in the marketplace, price for factors. The price for factors is what we're looking at here from the supply side. From the demand side, it's the price of the finished goods and services. So we're looking now at the production side with aggregate supply. So with aggregate supply, and I'm going to put it over here, we have the horizontal, which I will mention, it's called the immediate aggregate supply. This one here is the short run aggregate supply, or SRAS. I call it SRAS. The SRAS looks much like we saw in chapter 3 and 4 with the low on the left and high on the right. You see it's a kind of a diagonal, more curvy, but it's a diagonal, positively sloped, because as price levels go up, then suppliers in the marketplace, all of them, this is all products and services available, will produce more at that higher levels. It's Negative is sloped, and it's weighed down. It's sloped because of what's called sticky prices and menu prices. Suppliers are going to be limited to how fast they can increase production based on how quickly they can increase costs or how they can keep costs down, how effective they can. Where's the limit? There's a range for costs that you can produce at certain levels until there's a terminal level, and then you're going to have to spend more money for additional units of marginally increased supply or production. And the biggest cost that suppliers, manufacturers, businesses have is labor costs. Not just human capital, but labor. So that's all combined as one cost. And it's not easy to cut pay. It's easier to lay off people as a whole and have a large chunk of cost savings than incrementally, marginally, incrementally reducing cost. At the same time, if you're working for $10 an hour, it may be easy enough for them to reduce your hours and cut pay that way, but not to work you 20 hours, which is your normal, for only $8. That is a larger savings than cutting your hours, because if I cut your hours, I'm also cutting into productivity. So I expect that as labor, we measure productivity based on the number of products you make per time. If you have less time, you're not more productive, you're less productive. So if we want to maintain our productivity, we're going to work you 20 hours, but we'll pay you less so we can cut that cost. That's where it comes sticky. That's the sticky part. Because you're not willing to work 20 hours for less pay. I'll work less hours and for the less pay. That's a little bit palatable, a little bit more palatable. So sticky prices, menu prices is another thing. What menu prices mean is that suppliers, it's not easy to change price in the market. It's not easy because you have to reprint your menus. And I use menus in quotation marks because we're not really printing menu, especially post-pandemic. We're not going to be printing menus a lot. There's a lot of germs on those menus. But the concept is that you have to go through additional costs to change those prices. So you tend to hold your price for longer time because of that additional cost until there's a point where you have to expend that cost to make up that price. So menu costs are kind of part of that stickiness, but wage costs is that stickiness too. So because of sticky prices, it becomes positively sloped, but it's a slope. So it will move and productivity will increase. The level of production will increase as price levels increase to accommodate for the new price levels, as long as they can also minimize the increases in resource costs, which is your factors costs. The third curve is the long run aggregate supply, or LRAS. SRAS is the negatively sloped, but notice what's going on here with the LRAS. LRAS is a vertical line. It's a vertical line because in the long run, changes in price levels will not affect the ultimate long run productivity or long run production, because one particular supplier may not be able to supply because the cost to them are too high, but someone else will. So there's going to be a maximum level, or not maximum, optimum efficient level of productivity, of production in the economy, and that's where LRAS comes in. And so that Y, where LRAS is vertical, is the natural rate of employment, of the full employment of all resources available. All factors of production are fully used. And I say that in quotation marks because, like Milton Friedman has said before, or I've said before by Milton Friedman, natural rate of unemployment is not 0 or 100%. The natural rate of employment is not 100%. It's a little less. It's about, unemployment's about 5, so the natural rate is about 95%. So this is really depicting about a 95, 96% employment rate of all factors, particularly labor. If there was a technological advance that makes all productivity better, if more efficient, that's when the LRAS will go up in a permanent way, because then we're going to have a different level of employment. Whether it's going to go down or go up, it's going to move. That's more permanent. Otherwise, LRAS stays fixed. Again, quotation marks, fixed in the long run, because unless you're going to have a huge amount of new resources all of a sudden, unless you have a huge number of employment that all of a sudden of new population that's going to be employed, it really is not going to shift. So let's combine them all together over here, all three. If we put all three curves together and they meet at a point, that point is going to be the price level, and that will be the amount of the most efficient level of real GDP at the natural rate of employment of all factors of production, particularly labor. And that is in equilibrium. What if so I forgot to mention that in addition to the aggregate demand being part of all those four parts of GDP in that formula, the expenditure model, each one of them can be a shifter of the aggregate demand. If consumption increases for some reason, and know that it's about 60-70% of GDP is the consumer consumption or consumer spending, that's going to shift the aggregate demand in a positive direction. If businesses start to produce more, or not produce more, but they're going to buy more coffee, buy more computers, buy more finished goods for the business, to be business to use, that's also going to shift it in a positive direction. If there's an increase in government spending, if the government spending that is counted towards GDP, like the government buying a new F-16 or several F-16s or a C-120, big, very big, the largest aircraft, that's the one that you put tanks in, or if they buy a Hummer or a Jeep from Chrysler, I'm sorry, not FCA anymore, but formerly FCA, Fiat Chrysler, it's now, the name escapes me right now. But if they buy a Ford car for the Army, any of those consumption pieces that the government's buying for itself, or if it increases spending on infrastructure, that means that's going to be a shift in the aggregate demand in a positive way, or to the right. So any one of those is a shifter. Now, if the government increases spending on unemployment, it raises the unemployment. Not raises, but increases the unemployment payments. Similar to what happened in 2020 under the CARES Act, the federal government supplemented the state level unemployment by an additional $600 every 2 weeks. $600 or $1,200 a month, on top of what the state governments were paying out in unemployment for a number of weeks there. And that is federal government spending more money. That additional money is not called or not counted towards GDP because it's called transfer payment. That's not counted towards GDP when the government spends on Social Security. Now, and it's not a financial transaction. We're talking about transfer payments from the Federal Reserve, federal government. That's not the part that's going to shift this, because that's not the part of government spending that's counted in GDP. But that money goes to people, and people are going to have now extra cash to spend, and those stimuli are going to, the stimuli spending that the government's giving to people's pockets are going to increase their spending. And that's really increases consumption, the C, and that will truly shift it, but it's shifted from the consumer spending side, not from the government spending side. If there was some reason, say that the interest rates, the federal government decides that they're going to keep interest rates low. Right now, the discount rate is about 0.25. Federal funds rate is very, very low. So businesses are going to be incited, because rational people, including businesses, respond to incentives. The incentive is lower interest rates. I'm incited to borrow more money. I'm going to borrow more money, and that's part of that demand. So I'm going to borrow more money to spend it on production pieces. That's going to shift the aggregate demand. Aggregate demand is going to shift in a positive way. But at the same time, I, as a business, am going to increase production. So I'm going to shift my aggregate supply. So aggregate supply and aggregate demand are both going to move, but aggregate supply is going to move more, because the reason why businesses are investing is to increase the supply of products. Now, you see what happens is, if aggregate supply shifts in the positive direction, what happens to the price levels? They go down. Price levels go down. As price levels go down, we're at a different point on the aggregate demand curve. So now we have shifted out, and we're no longer at that natural rate of employment, because we're producing and consuming over here on the right. That's called an inflation gap. That gap of more employment and lower inflation is not sustainable. So there's going to be a point where we have to come back to this LRAS. So what's going to happen? Aggregate supply is going to shift back. Demand may shift too, and if they both shift at the same time, they're still going to come back to this spot, which is on the LRAS, which is natural rate. What if there is, in 1972-73, there was a big thing that went on. And I don't know if you guys are old enough to remember, but we had what's called an oil embargo. The United States stopped importing oil from OPEC. And so trade between OPEC, the Association of Oil Producing Nations, Organization of Oil Producing Nations, petroleum exporting countries, and the United States had a breakdown in trade in the early 70s. And so we stopped importing oil. What happened was oil prices started to increase. As I mentioned in GDP, when President Kennedy was president, we were around 25, I think my graphic had 27 cents, 20 cents a gallon. But it did go up under Nixon, and it went up even more by the end of his term. When Ford was president, it was going up too, continued to go up in price, which was shocking at that time. Gas stations were running out of gas. There was long lines at the gas station for gas, people waiting for it. What happened then is that the price level of gas started to shift up, which was a factor of production. And so the aggregate supply curve started to shift leftward. And look what happens when it shifts leftward, not rightward. When it goes left, two things are happening. It's going below our natural rate of employment, which means if we're going below natural rate of employment, that means unemployment is going up. Less people are working. And at the same time, we have price levels increasing, not decreasing. So two things are happening. We have higher unemployment and higher inflation. That's called stagflation. Stagflation is not a good thing. And that, when we're on the left side here, that's a recessionary gap. And a recessionary gap is where we have low employment. or low employment, high unemployment. And at the same time, prices are going up. That's stagflation. So if we're below this point, it's a recessionary gap. If we're above this point, it's an inflationary gap, where the prices have to go up, or we are overworked. We have fewer jobs. And that's not sustainable, because the sustainability is at that point, that low point, where it's natural.